With Trading 212's introduction to pies, it allows investors to build their own portfolios of stocks, allocating a certain percentage to each, and enables automatic investing. This tool is excellent for cost averaging, so I built myself a portfolio that is suited for a long-term cost averaging strategy. So as you can see here, my portfolio consists of large companies with a strong dividend history. So I picked out a few different stocks that I think will fare well through a recession, or if there is another, well, we are in an economic downturn, but I mean if the stock prices continue to fall down, companies that I'd be happy to buy them at a lot lower price than what they are now. So for example, Coca-Cola, Microsoft and Walmart, they're all businesses that have survived through the coronavirus pandemic and will continue to thrive. They've been booming since the start of the pandemic. Walmart is an essential retailer, and it's a fantastic one at that. It's got an excellent business model. It offers cheap, affordable retail products, consumer goods. Coca-Cola is obviously the supplier. They have all the consumer beverages, and regardless of people's income, if the economy gets worse, more and more people lose their jobs, even though unemployment's at a record high. People's incomes go down, they're still going to be buying the basic beverages, Coke, juices, all of their wide range of products. Coca-Cola won't be going anywhere. I've also put money into PepsiCo because at the moment it's a bit more expensive, but it does look like it's got a better future earnings potential, which is why I've averaged out between Coca-Cola and Pepsi. So with Microsoft, that's a bit of a riskier one, just because of its high price is so high. It's definitely got a very positive future ahead of it. Definitely worth investing in. However, where its price is so high, that's why I've allocated my percentage to it quite lowly. So to mitigate that, because I believe the tech sector is going to go a bit further, is because despite its already high prices, there are some good buys out there, which is why I put some money into IBM. So they are currently working on cloud services, as you can see from this article here. So the pandemic will accelerate the adoption of cloud computing and artificial intelligence on a global level. And IBM has over 100 years worth of experience in technology, and they're a massive company and they work directly with businesses. And as this whole pandemic and work has increased people working from home, it means companies are going to be adopting more infrastructure to enable work from home, and the cloud operating systems is what's going to do that, which is why I'm taking a bit of a gamble of IBM. This and several other reasons, as you can see here. So from this executive summary, it has a very high dividend, especially for a tech company. So it's currently around 5.5%, and that's with a stable dividend, which means it's very likely to still pay it out. And it's also a very good price. The price has been going down for many years now. However, it has had some change in leadership and people running the company, so it looks like things will be able to turn around. And like I said, there is going to be more of a demand for it. And where IBM is constantly paying dividends regardless of its stock price, I'm quite happy to pay like I said, I think it's still a fair value. But even if it does go down a bit, the dividend should mitigate that. Well, I'm getting 5% a year from a dividend yield. And like I said, I have money in Microsoft to kind of average it out a bit. So another one of my top portfolio picks is AT&T. So again, looking at this article here, it's another very strong dividend company. It's been paying dividends for the past 35 years consecutively and also increasing them every year, which is a very, very nice thing to see. And that just adds to the snowball and compounding interest effect. So with this as well, about weathering a storm, if something does go wrong, their stock price falls, they've got plenty of cash. So what does it say here? In addition, last quarter's free cash flow was 3.9 billion, which means it can continue to pay dividends and it's got a lot of breathing room if anything does go wrong. On top of that, like I said with IBM, they've still got a good future ahead of it. So it's one of the 3 companies that has built a nationwide 5G network. Everyone has been hearing 5G stories all over the news, all about causing the virus and stuff like that. But regardless, it is a massive infrastructure change, and AT&T being one of the 3 companies that has current access to it, that will be a huge barrier to entry to many other competitors, which means it has got a very strong advantage as it has set up already, which is very nice to see. And with its already current price, quite fair thing, as I'll show you here in this executive summary, it's currently trading at Wall Street Daily or something, I can't remember the website's name, but according to their analyst, it's trading at 60%. They're below their estimate of its fair value, which is amazing value. But as with anything, you've got to take it with a pinch of salt. You need to do your own research on top of all this, whether you think it's a fair value or not. I'm always skeptical looking at people's value on stocks. This is for several reasons. For starters, because even before the whole stock market crash and pandemic, people were saying we were in a bubble and that stocks were overvalued regardless. So when you're looking at a stock's price, one of the best things you can do is compare it with competitors. But if the whole market's inflated and people are willing to pay more for everything regardless of value, that distorts the actual value. So be careful of that. But with around a 7% dividend or 6.5% dividend yield, again, it's another risk I'm willing to take, especially with its consecutive history of paying them out and cash to do so. So moving on, another good one, which is a bit different, is a Bae Systems working in the capital goods. I do have two capital goods investments. That's in Lockheed Martin and Bae Systems. They both design and create and manufacture military equipment and stuff like fighter jets and stuff like that. So Bae Systems is in the UK, and as with Lockheed Martin, they take on a lot of government contracts to build stuff for them. Again, this is another thing that's very safe if the market downturns, because regardless of consumer spending, income for the governments will go into debt to continue manufacturing military equipment, particularly in the US, which is why I purchased Lockheed Martin as well. But I thought Bae Systems, from this analysis here, it's a very good value and it's got a very high dividend of just under 5%. But with its strong past, it's built up a lot of cash and health to maintain that, even if contracts do flop. So I know some companies like Rolls-Royce is a bit different to this kind of sector, because they do a lot of cars and nuclear stuff, but they haven't got as much capital behind it, and it's not a strong business model to maintain, which is why I've invested in Bae Systems. So how I actually allocated my resources to each of the stocks was based on a variety of factors, mainly their dividend yield, which is directly related to their price. So for example, you can see Apple, I've only got a 2% holding in it, and that's because I thought Apple's a brilliant company and I wanted it in my portfolio, but I didn't want to allocate any more money to it just yet, because I thought its price was too high and its dividend yield is only, I think it is 1.2% or something very low, and the opportunity cost of having it in Apple, where it could potentially grow, on something such as AT&T, like I mentioned earlier, with a 6% dividend yield, which is pretty much very safe and almost guaranteed, it's not worth taking that risk. I'd rather have it in something I had a bit more certainty in, which is why I've allocated some of the more speculative stocks, especially in the finance sector. If there's a market downturn, they could be negatively impacted as debt rises, etc. And that's a risk I'm willing to take, but only to a certain extent. So I put more money into my discount retail stores such as B&M, Walmart, and like I mentioned earlier as well, like the Capital Good project, where individual spending doesn't really affect it too much. So that's my pie. That's everything I've got in my portfolio. Do let me know what you guys have bought in the comments below. And if you haven't signed up to Trading 212, use the link in the description. We'll both get a free share. And if you enjoyed the video, leave a like. And thanks for watching.